Consumers are doing a better job managing their credit card debt. Data released by Truist Bank analysts show that credit card holders of both higher and lower scores are doing a better job paying their bills on time. This is based on a drop in the rate of late payments from last quarter. Also, too, I thought this was quite important, but there is an improvement in debt servicing payments as a percent of consumers' disposable personal income. The first quarter shows debt servicing payments were roughly 11% of disposable income, which is a strong ratio considering that level is below what was typical before the start of 2020. And more importantly to me, it's far below the 15% plus levels that were seen leading up to the Great Recession in 2008. Also, too, according to Fed data, card loan growth was only 3% year over year, which could be due to lenders increasing their credit standards. Stricter standards also made it more difficult for subprime borrowers to obtain new credit cards, considering the fact that as a share of new card accounts, this category accounted for just 16% of all new accounts. This was down roughly 7% from the last quarter in 2022 when it was 23%. Consumers may also be more aware of the high interest costs considering rates stood at 22% as of May. There has been a decrease in rates from the peak last year, but Fed data reveals before interest rates began rising in 2022, interest rates stood at 16% for card accounts. If the Fed were to drop rates a couple of times between now and the end of the year, we could see a small decline in the rate. With that said, borrowing money on a credit card and accruing interest is a terrible idea, as even a 16% rate would not be worth it. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment. Feel free to check out our other YouTube videos and weekly newsletter for latest economic news, expert analysis, and market insights.